Welcome. And in today's lecture, we're going to be discussing Forex terminologies. And at the end of this lecture, we're also going to discuss the different types of trends. So, first terminology you need to know in Forex is PIP. What is a PIP? Now, PIP stands for percentage in points, and a PIP in the Forex market is a common measurement for how far the price has moved. So basically, the PIP is used to measure price movements, just like how in measuring length you use the meter, in measuring weight you use kilogram, and all of that. So in Forex, we use PIP to measure price movements. You understand? Now, whilst most brokers these days go for the fifth decimal place, a PIP movement is actually the fourth decimal place. For example, 0.0001 is 1 PIP. So you just count the fourth decimal place, and that number on the fourth decimal place is your PIP. For example, if you have Euro USD and it's currently trading at 1.1558 and it rises to 1.1562. So what you need to do here is basically just subtract 1.1562 from 1.1558, and you're going to get 0.0004. You understand? So that fourth decimal place is what you're going to consider, and that number 4 is your pip count. So it's 4 pips difference. The movement is 4 pips from this point to this point. The movement is 4 pips. So let's continue. However, some currency pairs have their pips located at the second decimal place, mostly yen pairs. So in as much as the PIP is the fourth decimal place on most currency pairs, but then some currency pairs like the Japanese yen pairs, they are structured differently, so they have their own on the second decimal place. I'll give you an example here. So for example, if USD JPY is currently trading at 110.25 and falls to 110.10, that fall equates to a change of 15 pips. So basically you're just subtracting this from this, and then you're going to get something like 0.15. So if you calculate that, you see that the pip count is actually 15 pips difference. So the movement from this point to this point is a change of 15 pips. I hope that's clear. So now let's talk about the next terminology you need to know. This one is not really important because most traders don't even consider this important to them. Me, myself, personally, I don't use this while trading. It's so small and so insignificant that it may not really affect your trading. So let's just go on. A PIP represents the fourth decimal place of most currency pairs, and the second decimal place in some currency pairs like the yen pair, as we discussed earlier. But there is an even smaller increment that price can change, and it's called a pipette, and this equals 1/10 of a pip. Example, 10 pipettes is equal to 1 pip. So you see that 1 pip is the SI unit basically of measuring the movement in price, if I should use those terminologies. But then a pipette is 1/10 or 1/10 of a pip. So it's basically not significant per se if you're to go that direction, because a pipette doesn't really affect your price movement. It doesn't really affect your balance as a trader. You understand? So that's why most people do not consider using the pipette. So let's go on. A pipette is located at the fifth decimal place of most pairs, and in the yen pairs they are located at the third decimal place. So you know a pip is the fourth decimal place in most pairs, and on the yen pairs is the second decimal place. So a pipette is just a decimal place after, so which is the fifth decimal place on normal currency pairs and the third decimal place on the yen pairs. So moving on, most traders don't follow movement in pipettes, just like I've explained earlier, even though some brokers use them in their trading platform. Today, pipettes are mostly used to measure the bid and ask spread, where 1/10 of a pip is needed. For example, the spread in Euro USD might be 1.4 pips or 1 pip and 4 pipettes. Well, we're going to talk about the bid and ask price very soon, and we're also going to talk about spreads very soon, so you can understand this part. So moving on, let's talk about bid and ask price. So at any given moment, each currency pair has two exchange rates or prices, the bid price and the ask price. So what's the difference between these two? Now, the bid price is the price at which the buyers are willing to buy, while the ask price is the price at which the sellers are willing to sell. So if you go to your, this is just a screenshot of the MetaTrader platform on a computer. So if you go to your charts, you'll see two lines on the chart. You understand? When price is moving, they're usually very close to each other. This is a zoomed in chart, so it looks kind of far apart, but they're usually very, very close together. So you see the first line here and you see the second line. Now normally the first line, which is, let's use this first red line, is normally the price at which the broker basically is willing to buy that particular currency pair. So if you take a buy trade on Euro USD, for example, the buy would happen on this price. You understand? On this price, because this is the ask price, and then this is the bid price, which is the price at which the broker is willing to sell this particular currency pair, in this case Euro USD. So that's the difference between the ask and the bid price. I hope this is clear. So now let's move on to spread. Now spread is the difference between the ask and the bid price. Each time you enter into a trade, you have to pay transaction cost for that trade, that is commissions. But while most brokers don't charge commissions and fees on placing trades nowadays because of the high competition in the brokerage industry, the bid and the ask spread remains the main cost to forex traders and the main way brokers make their money, because brokers make money in two ways. Either they make money from charging you commissions, or they make money from the spread, basically. So that's the difference between the ask and the bid price. So when you buy at a certain level, they have the spread, which is the difference between where they buy and where you buy as well. So they make the difference between the ask and the bid price is the profits the brokers make themselves. So if you're a day trader or scalper, you need to pay attention to the spread, since it can eat a large portion of your profits at the end of the day, which is very important. If your spread is wide, you don't want to be trading at that time of the day. You want to trade when the spreads are very tight, you understand, so that you make most of the money and your broker makes very little of the money. So swing traders and position traders who have a longer term approach to trading are less affected by the spread, as they open smaller number of positions and have relatively high profit targets. Yeah, because let's say, for example, you're a scalper or a day trader, and you take a trade and your profit target is like 5 pips, for example. As a scalper, your profit target is 5 pips and your spread is 2 pips. You see that almost half of your profits is gone just to spreads alone. So you want to be trading when your spreads are maybe 1 pip or even less than 1 pip, so that at least majority of the profit still goes to you. I hope that's clear. But for swing traders who target massive returns, so they may be looking for 100 pips or 200 pips, you see that the 5 pip spread is not really significant to them, so it doesn't really affect them the way the spread would affect a day trader or a scalper like you. So yeah. Okay, so let's move on to the next terminology you need to know, and the next terminology here is lot size. Now, lot size is one of the most important things you need to know as a trader, aside the pip. Lot size is like the second most important thing you need to know as a trader. So what is lot size? Let's go back. So lot size is the volume of your trade. It's basically used to determine how much you want to risk per trade. You understand? So let me explain more. There are 3 types of lot sizes. So you have the micro lot, the mini lot, and the standard lot. So the micro lot is written as 0.01 on your MetaTrader or your trading platform. You see it written as 0.01 lot size, and it equates to $0.1 per pip, which is 10 cents per pip. So each pip movement in price gives you $0.1. You can either make or lose $0.1 depending on if the price moves in your favor or against you. So we have the next one, which is mini lots, and it's written as 0.1, and it equates to $1 per pip. So for every pip movement in price, you can either make or lose $1. So for example, let's say you take a trade and price moved 10 pips in your favor, you make $10. If price moves 100 pips in your favor, you make $100 if you're using a mini lot. And also, you should also note that if price moves against you 10 pips, you lose $10. If price moves against you 100 pips, you lose $100. So be careful about that, especially when you're using small accounts to trade. Because if you're using a $100 account to trade, for example, and price moves 100 pips against you, you've blown the account. So it's necessary to understand how lot sizes work, so you can work on your risk management and be able to protect your capital. So now the next and the biggest lot size we have is the standard lot, which is written as 1.0, and it equates to $10 per pip. So for each price movement, you either make or you lose $10. So if price moves 10 pips in your favor, you make $100. If it moves 10 pips against you, you lose $100. So be careful about that. You don't want to be using a standard lot on a small account like a $100 account, because very little movement in price and your account is gone. You understand? That's if price goes against you. So it's good to understand lot sizes so you can practice proper risk management. In the mentorship, we're going to discuss more on lot sizes and make you understand how you can use lot sizes to practice proper risk management and not blow your account. Because if you use the wrong lot size for the wrong trading account size, you're most likely going to lose the entirety of your funds and you're going to blow that account. So we're going to explain and help you understand which lot size is best for your particular account size. So moving on, next thing we're going to talk about is slippage. Slippage is something every forex trader should know because it happens regularly on a live market. You may not really see slippage on a demo account, but you see it mostly on a live market. So at times you would find that the price you try to enter a trade was not the exact price that you had your order executed, and this is called slippage. So basically, slippage is when you enter at a certain level and the market does not fill you in at that level, but fills you in at maybe a better price or a worse price. That's called slippage, and it happens when there is high volatility in the market. So the largest factor that creates slippage in the market is large volatility, and this can often be caused by news announcements or unexpected market shocks. So most times when you have high impact news events, it's not advisable to trade because you may be prone to slippage, positive or negative slippage. So it's best to avoid those times of the market. Also, when there's very low liquidity in the market, you could also experience slippage, like during swap periods and stuff like that. When the market is closing or when the market just opens, there might be slippage, or the spreads might widen so much that you enter at a certain point or it executes your trade somewhere else because of widening of spreads. So yeah, moving on. So we have going long or short. So now when a trader is going long, it simply means that they are buying and looking for price to move into higher positions. And when a trader is going short, it means that they are selling and looking for price to move lower. That's just the basic meaning of going long and going short. It's just buying or selling, different terminologies for it. So we have bullish and bearish. Now, have you ever heard of a bullish market, or have you ever heard an economist say we are now in a bearish market or a bear market? So what does this mean? Being either bullish or bearish refers to what side of the market you're on. So if you're bullish, you think that price would go up, and if you're bearish, you think that price is going to fall. So a bullish trend is a trend that is going upwards, and a bearish trend is a trend that is going downwards, simply. So for example, a bullish trader may say, I have just entered a long position or a buy trade with the strong trend higher. You understand? Because he's expecting the trend to be bullish and for prices to go higher. So next thing we'll talk about is leverage. Leverage is something else that is very important in the market. If you understand leverage, you understand how the forex market works, how lot sizes works and all. And leverage is one of the reasons why a lot of investors move into the forex market. Is one of the things that most other markets don't offer, leverage. So trading on leverage allows traders to open a much larger position size than their initial trading accounts would otherwise allow. And the forex market is known for extremely high leverage ratios offered by retail brokers. For example, you may have a leverage of 1:100. Now, these leverages can go up to 1:1000 or even 1:2000, or some brokers even offer 1:unlimited leverage. So, but for this example, we use 1:100. So 1:100 leverage means that a $100 trading account can open positions of up to $10,000. So basically, you're just multiplying the leverage by your trading account, and you see the amount of buying power or purchasing power you have in the market. So leverage basically gives you a higher purchasing power. So this may have a positive or negative effect on a trader's account balance. Hence, leverage is referred to as a double-edged sword. So you should understand that even though leverage is a very, very juicy advantage that the forex market gives to the traders or investors, but then it could also go against you, because in as much as you can make a whole lot of money because of leverage on a small account, you could also lose the entirety of your funds. You could blow the entire account because of the same leverage. So it's a double-edged sword, basically. So moving on, we have a broker. A forex broker is a financial service company that provides traders access to a platform for buying and selling foreign currencies. So the broker is just a middleman between you and the financial markets. So if you execute a trade, it goes through the broker into the financial markets or the liquidity pool. You understand? So when you take a buy position, it's your broker who executes that buy position for you, and that's how you make money. Without a broker, you will not be able to trade, basically. So examples of brokers you find, especially in Nigeria, include Xness, Hot Forex, IC Markets, Infinox, and KOT Forex. Now there are two types of brokers. You have regulated brokers and non-regulated brokers. So basically, the regulated brokers are safer because they are regulated, and then they feed your trades directly into the liquidity pool. But then the non-regulated brokers feed your trades into their own liquidity. So if you're making money, they pay you from their pockets. If you're losing money, you pay them. Basically, your money goes to them. Unlike the regulated brokers, where whether you're making money or losing money, all that goes into the liquidity pool. You understand? That's the central bank, and no, they have nothing. They're just basically a middleman. So the only way they make money is from commissions and spreads, basically. So in these examples I listed here, number 1 to 4 are all regulated brokers, while number 5 is a non-regulated broker. I decided to add number 5 here so you guys can have an example or an idea what a non-regulated broker looks like. Yeah, so in the mentorship, we're going to go through each and every one of these brokers so you can choose the best one for you. They are all very good brokers, don't get me wrong, but then you should be able to make your own decision and know which broker works best for you based on the services they provide, customer care support, withdrawal speed, deposit speed, spreads, commissions, and all of that. We'll go through every single one of them. We can't do that on this lecture because it's going to take a lot of time, so we'll do that in the mentorship instead. So that brings us to the end of the terminologies you need to know as a beginner in Forex, and we're going to be moving on to the types of trends in Forex. So now there are 3 types of trends in Forex. We have the uptrend, we have the downtrend, and we have the sideways trend. Now the uptrend basically is a trending market to the upside that creates higher highs and higher lows. The downtrend on the other side is a trending market to the downside, which creates lower lows and lower highs. And then the sideways trend is a ranging market. It just creates relatively equal highs and lows. So I'm going to show you guys what I mean. So an uptrend looks more like this. You understand? Price is just moving to the upside. It keeps creating higher highs and higher lows to the upside. And a downtrend looks more like this. Creates lower lows and lower highs. Something like this. While a sideways trend doesn't create higher highs, it just creates relatively equal highs, because they may not be exactly equal, but then it just keeps ranging, moving to the side like this. So you can see that these highs and these lows are relatively equal. And in the uptrend, you see that price is moving to the upside, and in the downtrend, you see that price is moving to the downside, basically. So that's basically what the trends look like. Uptrends are moving up, downtrends are moving down, sideways trends are moving sideways or ranging, basically. So we're supposed to go to the charts to learn more about the trends, but for the sake of the length of this lecture, we're going to do that in the mentorship. Basically, the illustrations I showed here just gives you an illustration, a pictorial version of what these trends look like. But then in the mentorship, we're going to dive into the charts and show you these things on live charts, so you can be able to experience it and see what it looks like on the candlestick charts. So I would love to see you in the mentorship. It's going to be a nice one, going to be a wonderful experience. You're going to learn so much more in the mentorship. So with that being said, we've come to the end of this lecture on Forex terminologies and the bonus lecture on trending markets, types of trends. And I hope to see you in the next lecture. Thank you very much.